Do you have a house that you want to sell, but you're kind of avoiding the sale because you're afraid of the taxes you'll have to pay on the gains that you've made? Well, I'm going to share with you some strategies on that today. I mean, the first thing, if you own real estate and you want to sell it, and let's just say you bought it at a lower price, it's appreciated a lot, you're worried about the taxes that you're going to have to pay for your gains now, right? Capital gains are, depending on your tax bracket, things like that, long-term, short-term. I mean, a lot of people use kind of like 20% as kind of a general number there. So let's just say you bought a house, it was like 200,000, all right? What if it is worth 600,000 now, all right? That's very possible considering what happened with prices of real estate, right? So you bought it for 200K, selling it for 600K, that's 400K that we're talking about, right? So capital gains taxes on that is like $80,000, all right? How do we avoid that $80,000? Well, there's a couple things. First, you have to determine, was this your primary home, a house that you lived in? It was an owner-occupied house that you lived in, all right? That's one way. Or was it an investment property, all right? I'm gonna start by talking about if it was your primary home. So if it was your primary home, and you lived in it for 2 of the last 5 years, you actually qualify for an exemption. It's a tax exemption. If you're a single person, it's $250,000, and if you're married, then it's $500K. If you are married and you bought a house for $200K and you sold it for $600K, you owe no taxes on that $400K if you lived in it for at least 2 out of the last 5 years. So why do I say 2 out of the last 5 years, right? Well, I'll give you an example, right? So let's say I owned a property and I moved out of it and moved into a different house, but I did live in this house for, let's just say, at least 2 years, all right? I have up to 3 years still to sell that property still. So I can rent it out for like 3 more years, but as long as I sell it within that time and I've lived there 2 years out of the last 5, I qualify for that tax exemption. Basically, you don't owe any taxes on those gains if you lived in that house. That's one way, all right? The other way is a 1031 exchange, all right? 1031 exchanges only applies to investment properties now, right? So this is not a house that you lived in recently, okay? It's been a rental and you've been collecting rent on it, and let's just say same numbers. You bought it for 200K, now if you're selling it for 600K, how do you avoid taxes on that, all right? You wanna do a 1031 exchange, all right? So you may ask what a 1031 exchange is. It is basically like a tax event, more or less. And what you have to do is buy a replacement property with the proceeds, all right? So if you sold that house for 600K, now you have to go find another 600K house now, right? So you find another 600K house or more, and you roll all those profits into that, and now you can defer the taxes, all right? I say defer because you don't eliminate the taxes, all right? You just defer the taxes, all right? So you push it off into the future, all right? So that's, I think a lot of people have confusion on that. They say, oh, if I sell my house and as long as I buy it, another house, I don't have to pay the taxes, right? They're two separate things, all right? There's the tax exemption and then there is the 1031 exchange. So let's say you need to sell a property. Once you sell the property, you have 45 days to identify your replacement property. And what does that mean? Why am I saying identify, all right? Identify means you have to turn in something to the IRS, basically saying, I'm gonna use my funds from the sale of this property to buy this property, all right? And you have 45 days to do that, and you have 180 days to actually close, right? What is this recommendation that I would give you if you're doing this, all right? If you're in a really hot real estate market like we've seen in these past few years, right? It's sometimes hard to buy a property, right? Like you keep making offers, you get outbid, things like that. Like that's why you have 45 days to identify properties, right? So let's just say you have $500,000 to spend, right? Well, if you want to narrow it down to like 3 properties or 4 properties, you can identify all these properties as long as you have the address for it. As long as you buy at least one of those properties and close within 180 days, you will still be able to do the 1031 exchange. But you need to take the proceeds of the sale and basically roll it into another sale of equal or greater value. So if you sold the house for like 600K, you need to buy another house at 600K or more now. But what happens if you don't want to buy a house that expensive, right? Let's say you end up buying a house for only 500,000, all right? Well, what happens is you have a 1031 exchange for the 500K, the remaining 100 grand is still taxable, all right? You still have to pay gains on that. So at least you're not paying it for the entire amount, but you're paying it for the amount that you didn't use up. I recently talked to a couple that had recently retired. They have a primary home and they have an investment home. They want to sell the investment home to buy a retirement home, but they're not ready to sell their primary home yet. If you sell your primary home, you're exempt on the gains, okay? If you sell the investment home, then you have 45 days to identify a property to do a 1031 exchange on it. Well, then they told me, well, I already found the house that I want to buy. Can I sell the investment home later and still do it? Yes and no, all right? With 1031 exchanges, you're supposed to sell the house first and then buy a replacement property. If you've seen a house that you liked already, but you want to use proceeds from an investment property that you want to sell in the future, what are your options, all right? So this is probably a little less known strategy, and that's kind of what they call a reverse 1031 exchange. And technically, a reverse 1031 exchange is not really a reverse. You can't buy the house first and then sell the property. You actually have to sell the property and then buy the property. How do you get around this? So you do a strategy which is kind of called a reverse 1031 exchange. And what you actually are doing is you're paying an intermediary to basically buy that property for you and hold it for you, okay, until you actually sell your investment property, and then you buy it from that intermediary, all right? Just know that you have to pay for this service too. It's a tax event, right? So you need an intermediary to hold the money, right? So once you sell the property, it goes into an escrow account where they hold the money. You don't get access to it, right? Because once you get access to the money, you're gonna have to owe taxes on it, right? So that's why you're just kind of holding it in an escrow account until you're ready to buy something else. So you buy it from the intermediary, they charge you a lot of fees to set that up, honestly, right? So the difference is you have to decide, are my gains high enough that it's worth it for me to do this other thing? I mean, the costs can be anywhere from like $7,000 to $10,000 to do that, okay? So that's yet another option if things don't line up the way you want it to do. So just remember, if you own real estate, you want to sell it, and you do not want to pay all those taxes on it. Number one, if it's your primary home, you have an exemption, okay? $250 single, $500K if you're married, and that is living in the house 2 out of the last 5 years. You sell that, you're exempt, all right? The other strategy is the 1031 exchange. That's when it's an investment property. You sell it, you basically roll all your profits and proceeds into yet another investment property, all right? Or you can do a reverse 1031 exchange where you use somebody to kind of buy and hold it for you until you're actually ready to sell and buy. And then finally, what if you did a 1031 exchange and then later on, let's say you have a hard time renting it out, and then you move into that property, right? And then it becomes your primary home. You can actually qualify as it being your primary home now again. So that's how you use all these strategies together all at once, all right? I've done this many times for myself, and I've done it for a lot of my clients as well. So if you want to do a 1031 exchange, please reach out to me. I'd love to help you with that. I'll see you on the next one.